You can work from a beach in Thailand, but your income is likely still tied to tax systems built for the industrial age. Right now, Turkey operates as a highly incentivized tax hub, specifically targeting digital entrepreneurs and remote workers. Yet, many freelancers who move here end up accidentally overpaying their taxes by 20 to 40%. The difference between paying full standard rates and minimizing your tax burden comes down to a precise legal framework known as the Service Export Regulation. Having a remote job gives you geographic independence, but actually protecting the money you earn requires understanding these specific legal definitions. Let's track a standard monthly invoice. Take a remote freelance designer in Turkey who bills a foreign client for $5,000. To qualify for Turkey's 80% deduction, this invoice must meet 3 strict criteria. The client must be located abroad, payment must arrive in foreign currency, and consumed entirely outside of Turkey. Out of that $5,000 gross, 80% is legally deducted, leaving only $1,000 as your taxable base. A correct export invoice also completely bypasses KDV, the Turkish value-added tax, keeping VAT liability at exactly 0%. Warning tone: if you miss even one of those conditions, or just format the invoice wrong, you immediately trigger standard VAT liabilities on that entire amount. Correct legal classification is often more profitable than simply trying to earn more. One structural choice protects 80% of your gross income from tax. Next, we have to address the business entity holding that remaining $1,000 taxable base. A lot of remote workers assume they need to register a limited company, which brings high operating costs and complex compliance. For most freelancers, a sole proprietorship is cheaper, highly flexible, and perfectly suited for the work. The sole proprietorship structure allows you to offset that remaining taxable income with allowable business deductions. Turkey allows you to write off specific lifestyle expenses required to run your business. That includes portions of your home office utilities, your internet bill, software subscriptions, and hardware, like a new laptop. This foundation reduces your taxable base until the government's share is barely a fraction of your gross income. That original $5,000 invoice started as fully exposed gross income. Through the export deduction and careful expense management, it converts into legally protected net profit. But this system relies entirely on precise execution. Turkey's tax ecosystem offers massive incentives, but absolutely zero margin for error in the paperwork. Routing business income through your personal bank accounts or guessing on your invoice compliance are the 2 most common ways to break the structure. Make those mistakes, and you trigger the immediate loss of all your export deductions and VAT exemptions. Navigating this highly specific legal and linguistic landscape on your own almost guarantees you'll face financial penalties. Securing Turkey's distinct balance of lifestyle and tax efficiency requires professional guidance. Partner with an expert international CPA, like Ozone Consultancy, so you can build, defend, and optimize your structure correctly from the very first invoice.